Good afternoon. It's Mike Doyle and Tom Bennick with the mortgage firm Wellington Lake Worth, and we are here every Wednesday just to talk about different topics and answer any questions you might have about the mortgage process. Today, we're going to cover different types of loans, and we'll cover a little bit about what they do, when to use them, when not to use them. And if you have any questions, go ahead and just throw them in the chat. We've got people that go ahead and text us their questions too.
This is really a common question we get with the realtors and buyers. How many? What loan product is best for me? What's the difference between FHA, conventional, VA, USDA? There's so many different loan products out there that we find that we come across that quite a bit. So we're gonna cover some of that today.
These are an array of the types of loans we do. We're not going to dig too far into these, but we're just going to touch base kind of on the main ones. But everyone's heard like the top row, conventional, FHA, VA is 90 something percent of the loans we do. USDA is more rural areas. If you're maybe in the middle of Florida, some of the rural areas of Florida or some of the other states, USDA can be a really good loan with, you can get into those with very little money down. Construction perm loans, love construction perm, single close construction perm. We go ahead and we close, and then we give the draws to your lender. And once the loan is done, we lock it in for the 30 years. Jumbo loans are if they're over a certain loan amount. So anything over like 766, what is it, Tom?
550? 766, 550.
Excellent. And then non-QM is qualified mortgages. So QM is qualified mortgages. So we have to look at mortgages. Can the borrower afford it? Like, what are their ratios? Because people will say, like, what if I have $1 million? If you have no cash flow and you can't afford that monthly payment, then we don't care about the $1 million. So you have to be a qualified mortgage. So non-qualified mortgages mean we don't really look at that stuff. We look at some other things, and those obviously come with, some other issues. Non-wardable condos means that we can't get the condos to pass conventional financing. So we have to take different routes. And Tom, you work with a couple of the other stuff below.
Bank statement program, again, that's for, it's considered a non-QM or a non-qualifying mortgage, which means it doesn't necessarily meet the guidelines for Fannie Mae and Freddie Mac. But anyways, those are great loans for self-employed people. Most times there are bank statements. If we gather 12 months or 24 months of your business bank statements, in lieu of using your tax returns, we find that a lot of times we'll get a lot more income using your bank statements instead of using your tax returns for 2 years. Manufactured homes, don't do quite a lot of those, even though there is a product for them. Manufactured homes versus mobile home, which is a completely different product, which we don't cover. Reverse mortgages, which are pretty popular once you turn 62. And older, you no longer need to, make your mortgage payments. If you're interested in a reverse mortgage, the benefit to those are the older you are, the more money you end up getting. State housing programs, that the bond loans and bond programs that we offer, and of course, first-time home buyer programs also considered bond loans.
The first-time home buyer program, we are the top lender in the state of Florida for Hometown Heroes. Now, Hometown Heroes money has gone away, and then they just leak out a little bit. But hopefully they'll release another 100 million July 1st. That's their fiscal year. So we are hoping that another 100 million might leak out July 1st, and that would be great.
Sorry, go ahead.
No, go on. I just say that's been a great program.
Heroes program has been outstanding. Every time the funds get reallocated, the money goes in no time. So that's been a great program. It gives a huge benefit to the buyer, giving them a good chunk of money to help with their closing fees and prepaid items. Yes.
So let's cover a little bit of the most popular loans. All right. So we're going to start with conventional loans. Conventional is the most common of all home loans. They say they're fixed and adjustable, but right now the adjustables aren't pricing out any better than the fixed rate loans. So, I mean, I would do adjustables all day long. I'd be doing 5-year adjustables if we could do them if they were pricing out better, because we're projecting that everybody is going to go ahead and refinance, in the next couple of years. But the investors are also projecting that everybody's going to refinance in the next couple of years. So they're not all that excited about somebody getting adjustable rate mortgages, because somebody who's getting a 5-year mortgage is with the intent of refinancing. So But in general, we're doing 30 years. The 15 years have not been as popular. And it's just because the rate on the 15 years hasn't been a whole lot better than the 30 years. And then the 10 year, even in the best of times, the rate on the 10-year mortgage has not been much better than the 15-year mortgage too. But people are under the misconception that FHA loan is a great first time home buyer loan. But on conventional, if you're a first time home buyer, you can do 3% down. So if you've got good credit, if you have good credit, you have some money, your ratios are good, conventional loan is absolutely the way to go. So I see a lot of lenders will immediately, oh, first time home buyer, let's get you into FHA. The first thing is let's get you into conventional. And then if conventional isn't working, then let's get you into FHA. So there's definitely a time period where your credit score potentially is a little bit lower. So now your cost on the conventional loan starts becoming a little bit higher. And then that's when you start switching over to the FHA loan. But if everything is good, you want to be doing that conventional loan. And the nice thing on conventional loans is your mortgage insurance will drop off on a conventional loan. Now, if you buy a house, and let's just say it's $100,000, which you're not finding in Florida, but if you buy a house for $100,000 and you put $5,000 down, you get a $95,000 loan, that mortgage insurance is going to drop off when you owe $78,000. And that's going to be in 12 years or so. But if you have an FHA loan, it's never dropping off, ever. Now, if the value of your house goes up to $120,000 or $118,000, you're going to have 20% equity in that house. You can go ahead and get the mortgage insurance dropped off. So with conventional, the bottom line is mortgage insurance will drop off. You might have to be aggressive at initiating it, but on an FHA loan, it's never going to drop off unless you put 10% down, and then it takes 11 years to drop off. So.
And if you're wondering why somebody would do an FHA loan maybe instead of a conventional loan, all the loans that Mike, myself, and Elizabeth, who is not here today, but all of these loans come with different programs and different guidelines. So it's not like I could just put anybody in a VA loan or put anybody in a USDA loan. There's requirements and different requirements for every one of these loan products. And that's why when we sit down and have a consultation with you, we kind of dive pretty deep into your situation to see what loan program best fits your needs. So again, it's certainly not one fits all.
Yeah. And the conventional loans, as your credit score starts dropping, the conventional, the interest rate can start getting high. Now, one of the beautiful things when Tom was talking earlier about first-time homebuyer programs is right now, if you're a first-time homebuyer, your interest rates can be the same thing on a conventional loan. If you could have a 680 credit score and end up with the same interest rate as somebody with an 820 credit score. So an 820 credit score customer putting 35% down can end up with the same interest rate as a 680 credit score customer putting 5% down. So we call we call them LLPAs, but you're not having loan level pricing adjustments for having lower credit, buying a condo, putting little money down. So for first time home buyers, they can price out really well. Now, the one thing I will say though is as your credit score drops, the mortgage insurance goes up. And the mortgage insurance is sometimes that hidden interest rate that people don't see. So if you don't put down 20%, you're going to have mortgage insurance and you're going to have your regular interest rate on your regular mortgage. So we have multiple mortgage insurance companies that we use, and we'll price them out with multiple companies to try and get you the best mortgage insurance rates. And that's something I often see with our competitors is they might be quoting an eighth of a point better in rate, but their mortgage insurance could be $100 more a month than our mortgage insurance because they're tied into one mortgage insurance company.
And mortgage insurance, just to kind of go down a little bit of a rabbit hole, is not homeowners insurance. Mortgage insurance is something that's completely separate. It insures the lender, any bank, any mortgage company, and insures the lender in the event of a default. If you're not going to be able to put down 20%, then you're going to need to acquire or you'll get mortgage insurance, which is provided by mortgage insurance companies. But that's something that's mandatory. For all conventional loans, you put down less than 20%.
Now, I'll jump into the end of that rabbit hole, and then we'll turn and dig another rabbit hole on that. But the mortgage insurance, people say, what's the purpose of the mortgage insurance? Like if you're buying that $100,000 house and you put 20% down, you get an $80,000 loan, and you stop making payments on that mortgage. By the time the lender, investor, bank ends up taking it away from you, you're way behind on your payments. You got all kinds of bills, legal, everything else. they sell it now for $100,000, but by the time they pay everything off, it's $95,000. They still got their money back, so they don't care about the mortgage insurance. But if you bought that house for $100,000 and you took a loan out for $95,000 and you stop making payments on it, by the time they're able to get that loan back and take it and sell it, now they owe like $110,000 on it by the time they paid off all the late fees and the back payments. So the lender has ended up losing money on that. So that's what the mortgage insurance, it's insurance to protect the lender in case you potentially default on the loan. But for you to get rid of the mortgage insurance too, you have to keep making those payments and making those payments on time. Because even if you end up with having equity in that house, if your payments are coming in late, and it's a risky loan, the lender isn't going to be dropping the mortgage insurance because you're still you're still what could be seen as a customer that's in a high default category.
Yeah, that mortgage insurance, but depending on who the servicer is, you've got to call that servicer and ask them what their requirements are. Typically they're going to email you something or fax you something, and it's going to certainly depend on what your mortgage history has been over the past 12 to 24 months. They're going to definitely take a look at that. So again, mortgage insurance is great because it allows us to purchase properties without having to put down 20%. But it is a benefit also. It does cover the investor in the event of default.
A lot of people, I'll say, well, I'll pull a line of credit off of here so I don't have to pay mortgage insurance. You know what? A lot of times you're just paying so much more on your line of credit than that mortgage insurance. If you have good credit, mortgage insurance is a fraction. It is minuscule. But yeah, 800, the difference between, I've seen difference, like if you got an 800 credit score, you might have a $50 monthly mortgage insurance payment where somebody with a 650 credit score could be having a 350 mortgage insurance type payment. So it's a huge difference. Mortgage insurance is very credit score driven. So.
And a benefit to just a quick little shout out, I guess I'll call it, to the bond loans, because the bond loan programs really restrict not restrict, but they have much lower mortgage insurance premium factors. So bond loans are great with keeping down the cost of mortgage insurance.
Yeah, very good. All right, now Tom, you've done a little bit more FHA recently. Do you want to touch base, even though we've
FHA, Federal Housing Administration, of course, they're not just for first-time home buyers. They require 3.5% down. The difference, maybe if somebody was going to ask the difference between conventional and FHA, well, first of all, on a conventional, typically the seller contribution, I think, can't be more than 3%, depending on what they're going to be putting down. FHA can go up to 6%. As far as our, behind the curtain goes, FHA guidelines are a little bit more lenient than conventional. If the borrower might have a couple of bumps in their credit history. FHA also allows for a little bit higher debt to income number, which is a little bit more forgiving than conventional. However, on the other side, FHA makes us count student loans in a different factor than conventional. So again, when we go through this consultation with you, these are all the things that are like clicking in our head as we're having a conversation. Okay, student loans, maybe looking at FHA or conventional, and these are the things that we have to look out for. And hence every loan program has different guidelines. So, but FHA loans, sorry, they're great loans. There was a while there, nobody wanted an FHA loan. FHA loans are great loans. Nothing wrong with them. I've had a couple. I got nothing bad to say about any of them.
Yeah, when realtors, lots of realtors like, oh, we're not going to accept FHA loans. FHA loans are pretty simple loans. I mean, they're more forgiving. There's nothing really bad against an FHA loan. I know that sometimes they believe that the buyers, are going to be less qualified, and there may be a tad to that, but for the most part, there's usually, I would say, if you're the agent and you're looking at, do I accept the FHA loan or conventional loan, I would have a conversation with the lender. Because a lot of times it's something simple. Mm-hmm. And again, the FHA loan doesn't slow us up at all. I mean, you give us an FHA contract on Monday, Tuesday, we'll close it by the following Friday. Mm-hmm. So we can close loans the next week. FHA is no slower. Our bond monies, when we're doing Hometown Heroes, we'll close those as fast as we'll close any other loan.
Yeah.
So I love that. Florida Housing, they're not like a lot of those other down payment assistance programs where you need 60 days. Florida Housing it is seamless. The seller doesn't even need to know about it. It doesn't matter. It's not even a factor. But yeah, same thing with FHA. FHA is a great loan.
And Mike brought up a good point. If you're concerned as far as being a listing agent or the selling agent, or why, Tom, why did you choose conventional, or why, Mike, did you choose FHA over conventional? There's a logical reason behind it. So yes, we can certainly have a conversation as to why we might have chosen one loan program for a borrower over the other.
Yeah, definitely. And but I tell you, USDA, Department of Agriculture, generally thought they're rural areas, but sometimes you'll find pockets. Not around here though, but sometimes you'll have pockets where they actually qualify, and it might be around some more urban areas.
Wellington is getting to be Wellington's popular. Sometimes I guess Wellington or
Wellington, you got to go west. You got to start going to South Bay. I think
yeah.
USDA stuff. Yeah, but I think we can do South Bay, Belle Glade, some of those areas out there, or the middle of the state. You start going out to Clewiston, you can get some good USDA loans. But yeah, no down payment, reduced mortgage insurance. We can combine those with some of our bond money. So you do a Hometown Heroes with a USDA, there's truly no money out of pocket, and the additional money can be put towards your down payment. So you start combining. You end up with a VA loan with some seller concessions. You can take that whole down payment assistance and truly go towards your down payment. So
yeah, definitely with a VA loan. VA loans, of course, Veterans Administration. What's the difference between FHA, conventional, or VA loan? I would say the biggest difference is the borrower has to be a veteran. Where conventional and FHA, there are no requirements for that. But as far as a VA loan, it's a veterans loan for veterans that have served time in service. And we receive their DD 214 or their certificate of eligibility, which tells us if the veteran has been honorably discharged. And then, of course, we reach out to the Veterans Administration to see how much they would be insuring the property for. VA has no mortgage insurance or minimal mortgage insurance on it, but it is strictly for veterans. So when somebody asks what's the difference between the three of those, the biggest answer is the borrower on a VA loan has got to be a veteran, usually with an honorable discharge.
And now, can you have a co-borrower on a VA loan?
Of course.
Spouse. Has to be a spouse.
Right? Correct. You're right. Co-borrower, no, it's got to be a spouse. That's correct. We've had people. It's happened over the 20 years. Believe it or not, people have left the office at 9:30 or 10 o'clock, and a nice little conversation about financing came back at 3 o'clock with their marriage certificate. So it does happen.
We're like Cupid here sometimes. But yeah, VA though is a great loan. I tell you what, and there's nothing I hate more than when I hear a real estate agent saying we're not accepting VA loans. I love to make that phone call and say, I just want to make it clear. Did your brochure say that if you served our country, we're not going to sell our house to you, with one of your VA benefits? And you just back down. But
I was denied a couple of houses offers because of the VA approval, and they felt that maybe I wasn't putting enough skin in the game or whatever. Now, granted, I think some of that depends on market conditions. Maybe I bought at a time where there were a lot of people making offers, but yeah, I've been denied, or my offer has been denied because it was a VA loan. It sucked.
Look, VA loans are great too. There's nothing wrong with VA loans. VA loans are also smooth. They have easier guidelines also. They're like FHA. They'll allow higher debt to income ratios. The only thing with the VA loan is they have 10 days to get the appraisal done. But all of our appraisers, are all VA certified appraisers. It doesn't necessarily mean that it's going to go to an appraiser that, we know. But you know what? I'm not finding experiences anymore where the VA loans are coming in lower. That's just not the case. And again, you have 10 days. They have 10 days to get the appraisal done from when they pick it up. But we can still close it in 3 weeks. So there's no reason why we can't close a VA loan in 3 or 4 weeks. So it doesn't slow anything up. People get these ideas that things take a long time, and they don't. If the customer comes in and all the ducks are in the row, we have all the paperwork that we need from them. It's just a matter of getting that appraisal in and getting it back and closing. But yeah, don't be afraid of VA loans. They're the best loans out there. Generally lower interest rates. No monthly mortgage insurance. The only time is you do have upfront mortgage insurance. If you're a disabled veteran, fully disabled veteran, you have no mortgage insurance, upfront mortgage insurance on it, which is great. Now, if you've used it a second time, the mortgage insurance on the second time you've used the loan is a little bit higher. So what I generally say to people is if you can put 5% down the second time you use your VA loan, you can save yourself a lot of money in upfront mortgage insurance.
Yeah, it was explained to me once by an instructor that broke down why the second use is always so much more money, which made a lot of sense. The VA loan was created for veterans coming out of the war to, of course, purchase their property or their first home. And, coming out of the war, things were kind of tough. And so the VA created the loan to make it easier for veterans to be homeowners. They didn't create the loan for a veteran to buy a $500,000 or $1 million house and, move into a McMansion or whatever the heck you want to call it. So the second time around, cost gets to be a little bit more. But like Mike said, you could be exempt from that VA funding fee. Or if you're looking to purchase a home and you're putting down 20% and you're a veteran, I don't know if I would necessarily use the Veterans Administration loan. So there are times where it may not be the most beneficial.
Yeah, we definitely would take a look because, again, you look at that funding fee.
Yeah.
And you think, geez, could you maybe be getting a conventional loan if you paid that in points or even half of that in points, you might be able to get the same rate. So, we definitely want to make sure we're looking at everything and getting you into the right loan. So let's see, jumbo loan.
Next is jumbo loan. So what is a jumbo loan? A jumbo loan is when you are purchasing, when you have a loan amount that's higher than, drum roll please, I think 766,550.
Right
there. Good guess. Thank you to our support team behind the scenes there that got us that information. But 766,550. Once your loan amount, you could buy a $5 million house, whatever, and you can have a conforming loan for 766,550 if you put down that amount of money. Once your loan amount goes to 766,551, we'll call it, you now are a jumbo loan. Different guidelines, different credit scores, different criteria, different everything. So that's the difference between a conventional loan and now a jumbo loan is the loan amount. That's what triggers the jumbo loan.
Now, I got a question here from Brett, who I think read that last page a little bit too fast. And he says, can you really do 5% down on a jumbo loan? Tom?
Drum roll.
Oh, God. I don't have a special screen up to answer that one. I don't know where that popped up from. 5% down on a jumbo loan. I mean, 10% potentially. In theory, 10%. When people say, "Oh, somebody can do 10%," yeah, I mean, sure you can do 10%, but you might pay a whole lot of points up front to get that. So I always say, because a lot of lenders are always quoting, "Yeah, we can do it. Yeah, you can do it. Yeah, I can do 10% down maybe on a second home condo, and it's going to cost you about 5 points. And by the time you're done paying all your points, it's a high cost loan and you can't do it." But in theory, people say there's things that are out there, but is it really feasible? Are they out there? I would say a 5% jumbo, probably not feasible. Even at 10%, I mean, I know there's 10% out there, but they can start getting pretty expensive when you start getting 10% down.
The only one that I can kind of think of off the top of my head, and there's not much there, obviously, is like a doctor's loan. A doctor's loan would kind of get into that jumbo arena. Of course, with that, typically the bank or the institution might want, your checking account, your savings account, your business account. Mike and I both spend plenty of days at the bank working there. So there are loans out there, but they also want other things along with that. So
those doctor loans can be funny because people start putting out all kinds of different things on doctor's loans. I remember there were some where I had an established doctor and they were trying to get a doctor's loan and they were at their bank and they're like, "No, we're not looking for established doctors. We're looking for new doctors that are going to start building their careers with us."
Yes.
Thinking, you got to be kidding me. I can't get a doctor's loan from my bank because I'm too established or I don't know what they were looking at. If you've been licensed or practiced for so many years, they weren't giving loans out to them. But different doctors' loans have different programs, and a lot of times when I see that 10%, often it's built into the rate. Like you can, and not even so much now, but back in the day, you could raise the rate and absorb the upfront mortgage insurance. And right now we're doing one also where you can pay your mortgage insurance up front. I don't often recommend that, but sometimes if you're tight on your debt to income ratios, you pay your mortgage insurance up front, like you can give $10,000 up front instead of maybe making $250 a month in payments. And if you can get a 4-year return on that, that's not the worst. It's not the best though either. But again, that comes down to just taking a look at the numbers and finding out what makes sense for your situation.
FHA's maximum loan amount is $498,257. So if your loan amount is above that, that's another reason why we might go ahead and suggest you go conventional because you've already exceeded FHA's maximum loan amount. That's also done by county, but in general, I think that's kind of where we are.
Now, let's touch on multifamilies. This is something I really want to get into. I've always been big on this, and now they've relaxed some of the guidelines a little bit on it, but really like some of this stuff. Like, and we can do this on conventional loans, but on a conventional loan, a principal residence, you can do 3% down. You can do 2 units, a duplex. You can do 5% down. All right. Now you can do a quadruplex, a triplex, or a quadruplex, 5% down. So, you're talking loans up over $1 million on a quadruplex, and you can get those loans for 5% down. And we'll use, like, if you're doing a quadruplex, and let's say that each unit is renting out for $3,000 a month. Now you're going to live in one of them because you're buying as a primary residence, but the other 3 are going to rent for $9,000. We'll give you 75% of that $9,000, which is 45 and 2250, whatever, 66,750 or something like that. So we'll give you that much to your income to help you qualify. So
I also want to stipulate something with these units, 2 units, 4 units. It has to be your primary. You've got to go into it and at least anticipate on moving into the property as your primary resident. There are some things called post-occupancy checks. One of the biggest, darkest things in the industry is called occupancy fraud, where you say you might be living somewhere and you're not going to be living there. So we just, want to be sure that you will be residing in at least one of the units.
Yeah, when they open this up, because they're trying to open up the multifamily type purchasing. If you're going to buy a quadruplex with 5% down, with better interest rates, you're going to want to make sure that that's your primary residence, because that is absolutely going to be a red flag. That they want to make sure that if they've rolled out this program to help home buyers buy this type of stuff, and you're truly buying it as a primary, but you're immediately putting them all on their short-term Airbnb rentals, you're going to get caught. So I definitely don't recommend anybody abusing these programs. And again, like Tom said, occupancy fraud is one of the big ones that is being really looked at this time.
And we're held accountable for that. It's not like we're out of the picture with any of this. Any of these loans go bad. Any loan goes dark once it closes, and it could be 6, 7, 8 months later, you might get a phone call saying, "Look, Mr. and Mrs. Smith, blah blah blah." That's what they told me, and the next thing you know, you find yourself, in trouble, because it's not good. It's not fun when it comes back and rolls down on us at all.
Yeah, you just don't want to be doing that. And
No.
Again, like I said, when I'm dealing with first-time home buyers that want it, it's just not worth it. It's not worth it. When you look at your career of what you're trying to do, it's just not worth it. So, but if you're getting a triplex, quadruplex, and you're doing it as a primary residence, go live in it for a year. Just live in it for a year. Get the place how you want it, figure it out, and go buy another one next year if you want. So, we're happy to go ahead. Just be patient with it. I mean, it's something that came out it's a great program. Just don't abuse it. So, all right. Anything else we got? Anything else good to add? Was there anything back on that first thing that you wanted to touch back on?
What was that first thing? It wasn't the thing we didn't want to talk about, was it?
That was the email that you had sent.
Oh.
There we go.
We got them basically all kind of covered, more or less. Bank statements, manufactured. Look, there's all kinds of loan products out there. I know we're going on our 30 minutes, but there's all kinds of loan products out there. And every individual is different as far as, their income, their assets, their liabilities, their credit. Blah. Reach out to us. Give us a call. Have a little consultation. And look, we're in March? We're in March. And look, I know it's an ugly conversation, but rates necessarily have not come down. All right, there's no secrets. Interest rates haven't necessarily come down, but they're gonna. And what's going to happen, and Mike and I attend plenty of open houses over the weekend, and what I hear a lot of is, I'm going to wait a little bit till rates come down. I'm going to wait a little. As soon as rates start ticking down, you're going to get every buyer and their brother going back out there now looking at houses. So don't be the last one out there now looking at houses. Be prepared, because I'm telling you, the next quarter, the next 6 months, when rates start ticking down, buyers are going to be coming out flooding the market again.
I mean, they're down from November, so they're down probably 3/4 of a point, in rate from November. But we unfortunately look at these things too much and too often. So in the last month, we were doing great, just loving life, and thinking that we're getting ready to go. Then just in the last 5 days, we had a little bit of jump.
The CPI killed it. Well, like we talked about.
Yeah, the CPI was a little bit, but I still look and I say it's an eighth of a point in rate. And I think sometimes we overlook it on our side is, you look at it and it's gone up and you're all upset. But that big old jump didn't even represent an eighth of a point in interest rate. So it's not like interest rates jumped a point. And I believe, Tom, we were probably both back in Regions Bank when I think interest rates, and it might happen earlier this year where you might have lost a point of an interest rate over a period of a week, and that's when it's just insane. Here it was maybe interest rates went up an eighth of a point and then they'll bounce around a little bit. We'll kind of see where they fall out. But it comes down to, is it time? Like, and I have 2 kids that bought in the last 6 months. It's like, Dad, how long can I put my life on hold waiting for everything to be perfect? So, anyway.
Yeah. In other words, again, my thing with the interest rates, people look, interest rates are just as important to myself that are on this as anybody else. However, don't let it be your deciding factor. When you find the right property, and if the numbers work and the property is in the right location, you got to get a hold of that property because who knows when it's going to be available again. And if interest rates bother you, just do me a favor, please pull out your credit card statement, look at the back, and see what that interest rate is. You'd pay that on a credit card with no problem, but you won't pay 8% on a house where you're going to be getting, financial benefits over the years to come. So it's kind of crazy.
Well, look, we've got all our numbers down there. Mike Doyle, Tom Bennick, Elizabeth Lopez is not here with us today. It is, I believe it's spring break and she's out spending some time with her daughter. So good for her. But we're here every week. Give us a call if you have any questions, and we're happy to go through your loan scenarios with you.
Yeah, please share our information. Sorry about that. Anybody that wants to purchase, refinance, buy a house, go through some numbers, please give them our name and number. We run our business on referrals, so we certainly appreciate your referral.
Excellent.
Thank you, Mike.